Welcome back to Report of Silver, where we break down the biggest developments in the gold and silver markets and help you understand what is really happening beneath the surface. If you are serious about protecting your wealth, building your position in precious metals, and staying ahead of major market shifts, then you are in the right place. Today's discussion is extremely important because what we are seeing right now in the monetary metals market may not just be another rally. It may be the beginning of a historic revaluation event, one of those rare moments that only comes once in a generation. Before we begin, I want to ask you an important question. Are you positioned for what could become the biggest move in gold and silver in decades, or are you still watching from the sidelines, waiting for confirmation after the biggest gains have already happened? Drop your answer in the comments below, and if you value this kind of deep market analysis, make sure you subscribe and turn on notifications because the next few months could be some of the most important months precious metals investors have ever seen. Now let's begin with the first major development, and that is something many investors still are not paying enough attention to: relative performance. Most investors spend their time asking a familiar question. Where should I be inside the stock market? Should I own technology, energy, financials? Should I overweight the S&P 500 or move toward small caps? But that may be the wrong question entirely. The better question may now be, should you even be in the stock market at all, or is there a better place for capital to be deployed? And increasingly, the answer appears to be gold. To understand why this matters, we need to look beyond simple price charts. Many investors only watch the dollar price of gold. And yes, gold has been making headlines because of its major rise. But the smarter way to analyze this market is by comparing gold directly against other major assets, especially the S&P 500. This is where the story becomes far more powerful. If you plot gold not as a standalone asset, but as a percentage of the S&P 500, something extraordinary appears on the chart. Since the peak in gold back in 2011, when gold reached nearly $1,900 before entering a brutal bear market, gold had been trapped in a long-term relative downtrend versus stocks. For more than a decade, every time gold tried to outperform the S&P, it failed. Every rally hit resistance and was pushed back down. But that changed. Beginning around 2014, a clear resistance line formed on this relative chart. Gold repeatedly tested this line over and over again. It touched it, failed, touched it again, failed again. This happened for more than 10 years. Think about what that means. A decade-long structural ceiling had formed, and gold simply could not break through it. Then suddenly, in November, it did. That breakout matters more than most people realize. When an asset breaks above a resistance line that is held for more than a decade, it is rarely just a temporary move. It usually signals the start of a major structural trend change. It means capital is rotating. It means institutional money is shifting. It means something larger is beginning. And look at what happened immediately after that breakout. Gold was around $4,200 at the time of that November close. Fast forward just 3 months, and gold had surged by roughly $1,000. At the same time, the S&P 500 was basically flat. Think about that for a moment. Gold did not just outperform stocks. It exploded higher while stocks stood still. That is what relative strength looks like. That is what leadership looks like. This is exactly why professional analysts focus so heavily on spread charts. A spread chart tells you which asset is winning the battle for capital. When gold starts decisively outperforming the S&P after a decade-long base, that is not noise. That is a message. The market is telling you that investors are beginning to prefer hard assets over financial assets. And why would that happen? Because confidence is changing. Investors are looking at rising debt, ongoing currency dilution, persistent inflation risks, geopolitical instability, and weakening trust in traditional financial systems. In that kind of environment, money naturally seeks safety. Historically, that safety has often been gold. But here is what makes this moment even more important. This may only be the beginning. Breakouts from long-term bases often lead to multi-year advances, not just a few strong months. If this pattern behaves the way similar patterns have behaved historically, then what we have seen so far may only be the opening act. That means investors who still think gold is too expensive may be missing the larger picture. They are looking at price, but not structure. They are seeing the headline, but not the foundation underneath it. The foundation is telling us something much bigger. Gold has likely entered a new phase. And if gold has entered a new phase, then the entire precious metal sector may be preparing for something much larger. Because once gold begins to lead, the next assets to move are often the miners, and eventually silver. That is where this story gets even more exciting. And in the next part, we are going to examine a second breakout that could be even more explosive than gold itself. Now that we understand why the breakout of gold versus the S&P 500 is such a major structural event, we need to move to what may be the next and possibly even more powerful development unfolding right now, and that is the behavior of the mining stocks. This is where many investors become confused because they often assume that if gold is rising, mining shares should automatically rise with it. But history tells us that is not always true. In fact, there have been long periods where gold performs very well while mining companies lag badly. That underperformance causes frustration, and many investors begin to question whether miners still matter. But what if that entire relationship is now changing? What if the miners are about to reassert themselves in a major way? To understand this, we need to look at another relative performance chart, one that most retail investors never study. This chart compares the Philadelphia Gold and Silver Index, XAU, often called the XAU, directly against gold itself. In simple terms, it asks a very important question: how valuable are mining companies relative to the metal they pull out of the ground? This matters because miners are not just another way to own gold, they are leveraged businesses. When the price of gold rises, their profit margins can rise much faster than the metal itself. That is why mining stocks historically can outperform gold dramatically during major bull markets. If we go back to the 1980s and look at this relationship, we see something very clear. For decades, the XAU index typically traded at around 17% to 30% of the value of an ounce of gold. If you average that range, miners generally lived around 25% of gold's value. That was normal. That was historical reality. Then came the devastating bear market in precious metals. By 2015, that ratio had collapsed all the way down near 4%. Think about how extreme that is. A sector that once regularly traded at around 25% of gold's value had been crushed to just 4%. At that moment, many investors simply gave up on miners. They believed the sector was broken. They assumed the best days were over. But what happened next is incredibly important. Instead of continuing lower, that ratio stabilized. It formed what technicians call a base. For more than a decade, miners traded inside a tight relative range. Every time the ratio approached around 8%, it got pushed back down. It could not break higher. The market was effectively saying, not yet. But now, that may be changing as we approach the current monthly close. The XAU versus gold ratio is pressing directly against the top of that 12-year range. If it closes here, it will confirm a major breakout. And this is not just any breakout. This would be a breakout from a base that has been building for more than a decade. Those are the most powerful kinds of technical events because they represent years of accumulation, years of skepticism, and years of investors underestimating what is possible. Remember what happened when gold broke out against the S&P in November. Gold surged by approximately $1,000 in just a few months. That is what happened after a major relative breakout. So the natural question becomes, what happens if the miners now break out against gold? The answer could be explosive. Right now, even after this move, miners are still only around 8.7% of the price of gold. Historically, they used to live much closer to 17% or 18% at the low end of their old range. That means even a move back to the bottom of their historical normal would imply more than a doubling in their relative value. Let that sink in. We are not talking about some small move here. We are talking about the possibility that mining shares could dramatically outperform gold itself. And this is why serious precious metals investors are paying attention. The miners are beginning to send a message. They are saying, we are back. They are saying, we are no longer followers. They are saying, the market has undervalued us for too long. That message becomes even more powerful when you consider mining company fundamentals. Gold prices are near historic highs. Many mining companies have spent years reducing debt, cutting costs, and improving operational efficiency. That means their margins today are much stronger than they were in previous cycles. In other words, they are entering this potential breakout with healthier balance sheets and much better earnings power. That combination is dangerous for bears. Rising gold prices plus expanding profit margins plus a technical breakout can create exactly the kind of environment where institutional capital floods into the sector. And once that happens, these stocks can move much faster than the metal. So while much of the market remains focused only on gold, smart investors are beginning to watch the miners very closely, because if this breakout confirms, it could signal that the next phase of this bull market has officially begun. But even that may not be the biggest story, because if gold is breaking out, and if miners are breaking out, then we need to talk about the most volatile and historically explosive metal of them all, silver. And what silver is signaling right now could be even more dramatic than gold. Now we arrive at what may be the most exciting part of this entire market cycle, and that is silver. If gold has been the quiet leader of this bull market, then silver may be preparing to become the explosive force that changes everything. Historically, that is exactly how precious metals bull markets often work. Gold moves first because it attracts the serious capital, the institutional money, and the central bank demand. It establishes the trend. It confirms the new direction. But then,
Once confidence grows and momentum strengthens, silver tends to wake up. And when it does, it usually moves faster, more violently, and far more dramatically than gold. That is why experienced precious metals investors always watch the silver to gold relationship very closely. It is not enough to simply ask whether silver is going up. The more important question is whether silver is outperforming gold. Because when silver starts beating gold, that often signals the aggressive phase of the bull market, the phase where emotions begin to enter the market and where price action can become breathtaking. To understand what is happening now, we need to look back to 2011. That was the last major silver peak when silver surged to nearly $50 per ounce for the second time in modern history, matching its famous 1980 peak. At that moment, silver's value relative to gold reached approximately 3.1%. In simple terms, 1 ounce of silver represented about 3.1% of 1 ounce of gold. That was a major high point, and after that, silver entered a long and painful decline. Over the following years, silver underperformed badly. The silver to gold spread collapsed. Investors lost confidence. Many began to believe silver would never reclaim its former strength. In fact, just last year, that spread fell below 1%, an extraordinary sign of undervaluation. Think about that. A metal that historically has been one of the most powerful performers in bull markets was trading at a deeply discounted level relative to gold. That is usually where opportunity hides. Then came November. Just like we saw with gold versus the S&P 500, and just like we are now seeing with the miners versus gold, silver also broke through a major resistance level in November. That first breakout was important because it signaled the end of a long consolidation. Silver closed that month near 56ers. Many investors looked at that number and thought silver had already moved too far. They assumed they had missed it. But what happened next changed everything. Within roughly 3 months, silver surged from $56 to around $88. Even after a pullback, it remained dramatically higher. That is not normal market behavior. That is what happens when a structural breakout begins to unfold. The market is repricing the asset rapidly because it suddenly realizes that the previous valuation no longer makes sense. And here is what makes this even more important. The silver to gold spread is still strengthening. Despite recent volatility, the spread is actually making higher highs. That tells us silver is not simply rising because gold is rising. It is outperforming gold. That is a major distinction, and historically, it has been one of the strongest bullish signals in the entire precious metals complex. Now let's think about where this could go. If silver simply returned to its 2011 relationship with gold, around 3.1%, and if gold reached something like $6,000, silver would be around $186 per ounce. That alone would be extraordinary. But what if silver returned to the extreme seen in 1980, when it reached roughly 6.5% of gold's value? Suddenly you are talking about numbers that seem almost unbelievable to most investors today. And that is exactly why most people dismiss these possibilities. They look at today's silver price and assume future prices must move slowly and logically, but precious metals do not always behave that way. Once the market enters a new reality phase, price can move vertically. The old rules stop applying. The market begins searching for a new equilibrium, and that search often happens much faster than people expect. This is why some analysts believe silver could move into the $300 to $500 range far sooner than the market currently imagines. That sounds extreme until you understand how these spread breakouts work. Historically, when silver breaks out against gold after a long base, the biggest gains often occur within the first few quarters after the breakout, not years later, quickly. That means this may not be a someday story. This could be a right now story. And if silver itself is preparing for that kind of move, then the next obvious question becomes even more exciting. What happens to the silver miners? Because if silver rises sharply, the companies producing it could experience a margin expansion unlike anything we have seen in years. And that is exactly what the next signal is beginning to confirm. If the breakout in silver is as powerful as it appears, then the next logical place investors need to focus is on the silver mining sector. This is where the leverage effect becomes truly extraordinary. Many investors understand that silver can move quickly, but what they often underestimate is how dramatically silver mining companies can move once silver itself enters an acceleration phase. This happens because mining companies do not just benefit from higher prices, they benefit from expanding margins. In simple terms, if the cost to produce silver stays relatively stable while the selling price rises sharply, profits can explode. That is exactly why mining shares have historically been some of the strongest performers during major precious metals bull markets. In some past cycles, mining shares have outperformed the metals themselves by multiples, not percentages. And now the charts are beginning to suggest that this process may already be starting again. When analysts compare silver miners to gold miners, another important relative strength signal appears. Recently, silver miners have begun breaking out against gold miners. That is a very powerful message. It tells us that the market is not just favoring precious metals in general, it is beginning to favor the more aggressive side of the sector. That usually happens when investors start believing the bull market is entering a stronger phase. Think about what that means. First, gold breaks out against the S&P 500. Then mining shares begin breaking out against gold. Then silver breaks out against gold. And now silver miners are starting to outperform gold miners. That is not random. That is a chain reaction. That is the market rotating deeper into the precious metals complex, moving step by step toward the assets with the highest potential upside. This is exactly how major sector bull markets often unfold. At first, conservative money moves in. That money buys the safest asset, gold. Then confidence grows, and investors move into higher risk opportunities like miners. Then, as momentum builds, they move towards silver, which is more volatile. Finally, when conviction becomes strong, they move into silver miners, which often represent the highest risk and highest reward part of the entire sector. That appears to be what we are seeing now. And the reason this matters so much is because silver miners have been ignored for years. Many investors wrote them off. They were considered too risky, too volatile, too disappointing. But that long period of neglect may have created the exact setup needed for a powerful upside move. Under-owned sectors can rise much faster than crowded sectors because there is so much capital waiting on the sidelines. Now combine that with improving fundamentals. Silver producers today are in a much better financial position than they were during previous cycles. Many have reduced debt, improved efficiency, and strengthened their balance sheets. If silver prices rise sharply from here, those companies could see profit margins expand dramatically. And when that happens, institutional investors often begin to pay attention very quickly. But there is another major reason this move could accelerate: psychology. Most investors still do not believe this bull market is real. They see gold and silver moving higher, but they assume it is temporary. They expect a sharp correction. They believe they will have another chance to buy lower. That skepticism creates fuel for the rally because it means many investors remain underexposed. As prices rise further, fear of missing out begins to replace skepticism. That is when momentum can become self-reinforcing. We may be entering that stage now. This is why many analysts are calling this a new reality phase. A new reality means investors must stop thinking in old price ranges. It means they must stop saying things like, silver cannot go above $100, or gold cannot reach $8,000. Markets do not care about what feels comfortable. Markets care about supply, demand, capital flows, and psychology. When those forces align, price can move much further than most people imagine. And right now, all of those forces appear to be lining up for precious metals. Gold is leading. Silver is accelerating. Miners are awakening. Silver miners are outperforming. That combination is extremely rare. But every serious investor must ask one final question. What could stop this? What could reverse this entire thesis? What would have to happen for this bullish outlook to fail? That is exactly what we need to examine next, because understanding risk is just as important as understanding opportunity. And according to the current technical evidence, the answer may surprise you. As powerful as this entire bullish case for gold, silver, and the mining sector appears, every serious investor must ask the same question. What could go wrong? What would need to happen for this entire thesis to break down? What signal would tell us that this rally is ending instead of just beginning? These are the right questions, because disciplined investors do not just chase upside, they constantly monitor risk. Interestingly, the current technical answer is very clear. Right now, there is no major evidence of a top. That does not mean prices will rise in a straight line. Markets never move that way. There will be pullbacks. There will be volatility. There will be days when prices drop sharply and headlines suddenly turn bearish. That is normal, but normal corrections are not the same as major trend reversals. A true top usually leaves clues, and according to current structural analysis, those clues simply are not present. To understand this, it helps to look back at history. In 2011, when gold reached its major peak near $119 and $20, many investors believed the rally would continue forever. Sentiment was euphoric. Precious metals dominated headlines. But underneath that excitement, technical structures were beginning to weaken. Momentum indicators were rolling over. Long-term support structures were breaking. The warning signs were there for those who knew where to look. Some analysts recognized that and turned bearish months before the full collapse began. Eventually, gold entered a brutal bear market. That same kind of structural damage is simply not visible today. In fact, the opposite is true. Instead of breaking down, long-term structures are breaking upward. Gold versus the S&P 500 has broken out. The Philadelphia Gold and Silver Index, XAU, versus gold is attempting a major breakout. Silver versus gold has already broken out. Silver miners versus gold miners are now strengthening. Those are not topping signals. Those are expansion signals. Another important factor is momentum. In a mature bull market, momentum often begins to weaken before price peaks. That divergence acts like an early warning system. Right now, momentum remains supportive. There is no major long-term momentum breakdown. No major technical bridge has collapsed. The structures that would normally warn of a major downturn are not even close to being tested. That means this market may still be in its acceleration phase, and that is a critical distinction. Many investors think the biggest gains happen at the beginning of a bull market. Often that is not true. The most dramatic gains usually happen in the later stages, when confidence builds, media attention increases, and capital floods into the sector. That is when price behavior changes. Instead of climbing step by step, markets begin moving vertically. They stop waiting for investors to get comfortable. That may be what lies ahead. For example, if JP Morgan Chase and other major institutions are now discussing possible gold targets above $9,000, that tells you something important. It tells you that the mainstream financial world is beginning to acknowledge what precious metals specialists have been saying for years. That kind of recognition often happens late, not early. And if gold reaches those levels, what happens to silver? What happens to silver miners? What happens to mining margins? Those are the questions that should dominate investor thinking now. Because if gold reaches even $8,500, simply matching the scale of previous bull markets, silver could easily move far beyond what most investors currently expect. And if silver enters that kind of price discovery phase, the miners could become some of the strongest performing assets in the entire market. That is why this may be a lifetime event, not because prices are rising today, but because the structural setup suggests something much larger may be unfolding. A long period of underperformance appears to be ending. Capital appears to be rotating. Confidence in fiat systems appears to be weakening. Hard assets are regaining leadership. That combination does not happen often. So my message to you today is simple. Pay attention. Watch the spreads. Watch the miners. Watch silver. Do not get distracted by daily volatility. Focus on the bigger picture, because the bigger picture is telling us that a new monetary metals reality may be forming right now. And I want to leave you with one final question. If this really is the beginning of a once-in-a-generation move in precious metals, will you look back 6 months from now and wish you had acted sooner? This is Report of Silver. If you found this analysis valuable, subscribe, like the video, and share your thoughts below. Tell me, are you positioned in gold, silver, miners, or all three? Because from where I stand, this story may just be getting started.